Great. So, hi everyone, and good afternoon. I hope everyone has had an amazing start to the New Year's. It's really great to be able to reconvene with all of you in person here after so many years. Today, I feel incredibly honored and privileged to be hosting or moderating what I think is one of the most interesting sessions of the Deal Street Asia event. And not only that, but I am able to do so with this wonderful group of panelists next to me, all of whom are amazing and incredibly accomplished business leaders, but also people that I truly admire and respect. So maybe just to quickly kick things off today, we'll just go around with a quick round of introductions, and then we can take the Q&A discussion from there. So let me start to kick things off very quickly. So hi everyone, my name is Pitra Harun. I'm a managing director and co-founder of Asia Partners. Asia Partners is a late and growth stage private equity company investing in tech companies in Southeast Asia and also Indonesia specifically. So let me pass it over to you, Gibran.
Hi everyone, I'm Gibran Huzaifah. I'm CEO and co-founder of eFishery. eFishery is a fish tech company. We provide technology for fish and shrimp farming business in Indonesia. Multiple services from IoT devices, financing solution, input distribution, and off-taking business. We have 100,000 farmers plus and more than 300,000 ponds all across Indonesia right now.
Hey everyone, hey Petra, panelist. Pleasure to be here. Dara, CEO, co-founder of Pinhome. Pinhome is a growth stage prop fintech startup. We operate in Indonesia, 80 cities in Indonesia. We are building e-commerce, transactional e-commerce platform for real estate. Building basically world's first home-seeking, home financing, and home services in one app. We serve first-time home buyers, unlocking home ownership for better livelihood and financial inclusion for them. That's about me.
Thank you, Bisra, and dear all panelists and guests. My name is Gufran. I am CEO and co-founder of FMOS. FMOS is a retail enabler startup. Essentially, we are helping local brands to be able to expand and widen their market presence across Indonesia through the demand infrastructure that we are building. One of the core demand infrastructure that we are building is a reseller network that at the moment accounted to more than 150,000 of active reseller, of whom 70% are women. So we are helping these local brands to have salesmen, saleswomen across Indonesia to help them expand their business.
Hi everyone, nice to be here. My name is Chris. I'm co-founder of Social Bella. So we start 7 years ago as an online e-commerce focused on beauty and personal care. And fast forward today, we have grown ourselves to become the complete ecosystem for personal care and mom and babies as well at the moment. Our business consists of the B2C retails, online and offline, as well as the B2B and brand development. And we also have media and community management as well. So currently we are operating in 2 countries, Indonesia and also Vietnam. Thank you.
Thanks. Hi, pleasure to be here. My name is Harshit. I'm the founder of Koala. It's an insurtech company across Southeast Asia. Where in Indonesia, we have over 40,000 intermediaries who work with us. And to date, we've helped over 5 million people get insured. Thank you.
Great. Thank you all so much for the introductions. So let's kick off today's discussion. And I would love today's discussion to be more of a discussion rather than a Q&A format. So please feel free to also play off each other's answers. So to kickstart the discussion today, let's address the title of the panel, which is Disintermediating Indonesia's Most Traditional Industries. So the industries that all of you are disrupting here today are industries that have existed for a very, very long time. So the question is, how exactly can tech be a game changer in the industries that you're disrupting? And what are your companies bringing that is different than the traditional solutions that is already available in the market today? Maybe Harshat, we can start with you this time.
Sure. Yeah, it's an interesting question because insurance is an intangible service or product, and it's always been difficult for people to wrap their heads around it because it's because of that nature, right? And so we actually believe intermediaries are essential to this space. We believe that they provide a lot of value and are required in the space, but they can be more efficient, they can be more professionalized and trained, and at the same time, we believe long term there can be many more of them. In fact, right? And I think through that, we believe that the value that we can bring out is that when intermediaries do work and they continue to provide people with insurance, whether these are agents or brokers, they can provide it much more fairly, they can provide it faster, and hopefully in time they can provide a much larger variety. And just think of it this way, right? I mean, when you buy insurance, it's not just about buying insurance, it's also for a service element as well. And intermediaries are not just for buying, it's for service. And this is critical because at the time you need it most, if you're alone, it can be quite difficult. But having someone by your side can make a world of a difference.
Got it. Chris, you want to go next?
Yeah, I think for us, specifically in our industry, there are two main characteristics that is quite important. The number one is the trust from the stakeholders, and number two is the capability to understand the customer needs, right? Because I think specifically in our industry, the rapid changes on the trend is always happening. That's the only constant in our industry. So using the technology as one of our core strengths, we'll be able to deliver the trust that is needed by the industry, which is like you can easily find any reviews that is useful for the customers, or you can easily find any information that you want. So we can easily get the trust from the customer, from the potential customers that we have. At the same time, using the technology as well, then we can easily understand what is the needs that we need to be able to serve to our customers. So I think those are the things that we have been doing quite well compared to the conventional players at the moment.
We are in the business of helping local brands. Most of them are small, medium enterprises. In the field, if we see the growth of small, medium enterprises, it is not linear. In fact, in their growth journey, there are several cliffs. And for local brands, for SMEs to be able to move forward, it requires two things: different skills and different mindset, in which, to be honest, tech cannot provide a solution for that. Tech cannot provide solution for making the mindsets and the skill set right for these local brands to be able to transform. But once we are able to mentor them, guide them to have right mindset and right skill set, tech can help intervene in the scaling of their business. So FMOS is doing that. We are not just providing tech to help them grow, but more important than that, we provide environment and ecosystem for local brands to adopt right skill set and mindset for them to grow.
The question is, how do we deliver unique value proposition using technology? So we serve first-time home buyers in real estate. In the next 3 decades, there's going to be, we've estimated that there's going to be about 150 million millennials and Gen Z that are going to buy their first home. And there are a lot of inefficiencies in real estate, and for these first-time home buyers, multiple hurdles to get to their first home. We use technology basically to eliminate those hurdles. And those hurdles come in a form of inefficiencies in interactions, inaccuracy in information, redundancies, right, in roles of the different stakeholders, lengthy processes that are manual, paper-based, offline. And so that's how we use kind of technology. And talking about uniqueness, right? The classic questions that we get all the time is, how are you different with the first wave innovation in real estate? So that's like e-classified players, right? We are different. We are not e-classified player. E-classified player focuses on the discovery aspect of property transaction. And so that's kind of the top of funnel in property buying journey, right? There's discovery, and then you have kind of financing in mid-funnel, and then transactions at the end funnel. We are different in a way that we commission the whole process end to end, from discovery all the way to the delivery of ownership. Sure, there are processes that are still offline, viewing, offline visitations that still take place today, and it's hard for technology to completely substitute it. title signing by law that has to be offline, wet sign, right? But the rest of the journey should, and I think it's best, taken online. And technology allows that to happen. And through our platform, we ensure that the transition from online to offline, back to online, and ended offline, seamless.
Yeah, I think I just want to emphasize the question, which is very important, how tech can help to produce efficiency and provide value. Because in many cases, when disintermediating happens with tech, there's no added value actually to that disintermediation, which what used to be held by traditional middlemen right now is the modern middleman with the app. So there's no supply chain inefficiency that is solved. Where eFishery is coming from, we focus to revolve our solution to solve farmers' problem, particularly for aquaculture sector and overall agriculture sector. When there's a supply chain inefficiency, farmers always get the biggest burden of that inefficiency. They get the low value of the whole across value chain, although they actually holding the biggest risk on doing that. So coming from that view, when we started in 2013, we started off by providing farmers with the technology to help them increase productivity, which is feeding machine technology to feed the fish automatically connected to the sensor that can sense the fish appetite and sends the data to the cloud. And it was the initial idea that we just had. And as it turns out, once we deployed for first 4, 5, 6 years, we captured a lot of data information that was not available before. And the data is the disruptive part of it, not the technology itself. Because once we have the data, the farmers and the industry that is naturally and traditionally fragmented, we can aggregate and provide an aggregations. And that's a luxury that the smallholder farmers don't have. Because they're too small, they don't have access to the data, they don't have the economies of the scale. And by using the data, we're able to provide that economies of scale to then cut away and provide this intermediation. And then, for example, they can get a cheaper feed. And that's when we started distributing feed. Simply, not simply because we can do that, but simply because we can offer cheaper feed to farmers, and then we can offer a better access to the feed manufacturers on doing that. And the same thing that we do on the downstream, there are too many middlemen, 3 to 5 middlemen from the farmers to the end buyers. And particularly for fish, we harvest the fish alive, and then for Indonesian consumers, we also buy the fish alive and they kill it in front of us, which is essentially no added value on the product across the value chain. And then we use the data to be able to predict how many fish that will be harvested and sell it before it's even harvested to the more downstream buyers, so we can add value on doing that. At the end of the day, it's all about how technology can plays out, not just cutting around this and provide disintermediation, but whether the value can actually bring to the core impact, in our case, in the farmers, to provide a better price on the selling price, or also better price for their biggest cost drivers, which is on the feed part.
Got it. No, I completely agree with that. And maybe let's shift the topics a little bit and move into sort of the elephant in the room, which is the current macro situation. So obviously, the funding environment is a little bit slow at the moment, especially relative to the previous quarters. And the narrative for a lot of startups in previous quarters is that you need to grow at all costs. And that kind of profile works in a situation where capital is cheap. But when capital dries up, the narrative is now one where you need to be able to grow sustainably, and you also need to be able to get to break even quickly. So given that all the companies here that all of you are running are relatively mature companies already, what kind of operational adjustments are any of you making to your companies, if any, to be able to adapt to this current environment? Maybe Gibran, you want to kick things off?
Well, for us, we've been profitable for 4 years, so well, whatever other companies trying to get to, we were there first. So particularly, it sounds bragging, right? But particularly for us, we haven't been in a position where we are required to consume that capital and to grow at all costs. We are in the sector that's non-competitive, in an area that no one cares, in a company that no investors would like to invest. So 4 years ago, 5 years ago, when I pitched about the idea to most of the VCs and PEs, they said no to us because they know nothing about the industry. And the industry that involving like an IoT to go to the rural area is definitely not sexy for the most part. So when most of the startups right now have a winter of the funding, We've been there before. So 5 years ago, it was winter for us, which in a sense that give us a position to have an operation discipline much earlier than any other startups, because we know that in that front, we always have an existential threat if we grow at all costs, because we are not in the luxury to get that cheap funding. For everyone say the funding is cheap. Not for us. It's so hard to raise our Series A round. It's so hard to raise our seed round. And that it gives us a good discipline. So luckily for us, we're building a business that the customers want to buy, not the business that investors want to invest, which sometimes, at least over the past 5 years, is sometimes a bit different business and different model on doing that. So all kinds of discipline that we do. For example, I saw in Twitter that one, I think it's either coming from India or something. The founders published, they were trying to have an operation discipline by not flying on business and not taking personal drivers. Like, what surprise, right? So founders can fly business? Like, I never fly business all my life, even to the second, and we're making tens of millions of EBITDA right now. So which means that to show that, okay, maybe it's a bit different. And all of the time, we stop hiring and maintaining our hiring costs. We have been always maintaining our SG&A. And right now, with the whole fundraising, the P and V's ask, hey, what's your receivables? Which is quite new, and never in over the past 9 years I've been doing it, VCs ask about receivables. But 5 years ago, I always had like weekly meeting on receivables. Like even when there's some big customers have a problem, I go there to collect the money. So that kind of operation discipline, we've been doing it for the past 5 years, and it create a position where we've been a bit positive over the past 4 years. So not many changes for us because it's been winter all the years.
Right. Thanks, Gibran. Maybe we change the ordering a little bit and we go to Harshad first.
Yeah, so I think it is an interesting time. I think this is a time to make less decisions, which means that you just say no a lot. And internally, I tell the team that if you come to me, and most likely I'm just going to say no, unless you come like seriously well prepared and you can really make a very strong case as to how it will tremendously change that trajectory, right? But on the other hand, I think we're also in a position where I think the path forward for us is in a way clear, because we are CM2 positive, but we're losing money, which means that the only way to turn a profit is to go harder at it and scale more. Because if you scale more, you leave the burn behind, right? So the answer comes to us directly from the numbers. The strategy is very clear. It's written for us from that perspective, right? But to achieve that strategy, we have to be incredibly efficient in where we place our bets. Place, I think, fewer bets, but bets which can go long. And in particular there, I think we believe that keeping the sort of tech and product in check, because they love to build things. I love to build things. But I think we have to be much more resourceful right now, more scrappy. And if you can keep those overheads down and you're CM2 positive, then you go for more scale and try to get to a profitable level, right? And I think that's where we're at. But I think obviously prioritizing and many ideas seem good, but prioritizing into like really those 2-3 ideas for which we feel can do for the next 2-3 years is probably where it's at. Yeah.
Got it. Chris, you want to go next?
Yeah, I think this is very interesting questions in a way, right? Because I think not only this year, but last year we also, or the last 3 years, basically we all faced with the same situations, just in a different form, right? Because 3 years ago, like we first faced with the pandemic, which is also creates a lot of disruptions to the operations discipline as well as the cash environment as well. And definitely after that, luckily the funding becomes so easy, so it's coming to the good, quote unquote, the good funding sessions. And then now it comes to the term where there's a winter in the funding, right? But I think all in all, as a company, why don't we combine? I mean, as long as we have the good discipline, like what Gibran said, I think it's going to be a good way for how. Why cannot we be grow at all costs, but also sustainable, right? I think that is going to be the best of the combination from the both world. So what we did is actually from day one, we always focus on how to build a business that is sustainable itself, right? So it is actually coming to a very simple formula. Like as long as the customers that we acquire giving you much more higher customer lifetime value in comparison to the cost that is incurred to acquire their customers, then I think by all means you need to be able to, you need to do all the way to acquire as many as customers until the customer lifetime value is not become, the multiple not become so interesting anymore, right? I think that's going to be always the key for when we decide to grow. And secondly, we also need to think differently with the others when we try to decide on the prioritizations, how to use the cash. That's also very important. For us, like for example, the case is quite interesting. Last 2 years ago, when the pandemic happened, when all of the offline activities become restricted, actually we did the other way around. We did invest a lot in the offline. We opened our first omni-channel store as well during the pandemic, and we grow very fast. We grow from only having 2 stores in 2019. By now, we already have more than 50 stores in Indonesia, as well as another 13 stores in Vietnam. So why we did that? Because we believe that this is one of the investment that is worth to make. Because at the end of the day, this is gonna give us a growth that is sustainable, right? And thankfully, I think we are right at the moment, because after the reopening, we saw a lot of good benefit because of the impact of the reopening towards our business, right? And definitely now is the time when fundraising become very tough. So the prioritization is become very important in order to to pick and choose which one to invest next. But I think the opportunity will always come as long as you have that kind of principle that is focused on the sustainability, and as long as the formula is being done right.
Yeah. As a context, FMOS is cash flow positive, excluding salary. So since day one, we are disciplined not only in making sure that the contribution margin is positive, but we need to also look at the cash cycle. We have a discipline in making sure that in terms of the cash cycle, at least neutral to positive. So the reason, the way how we did that is perhaps to some of us it's natural to understand that every initiative should create value to users. And then when we create values, we need to make sure that the profit formula makes sense for us to capture some of value in terms of profit. But surprisingly, many executives, including in FMOS, VPs levels, senior managers level, is not natural understanding this concept. So we invest heavily in making sure that everybody in FMOS, especially in the leadership level, understand about the value creation aspect of making business, of making initiatives. So that when we develop something, when we have some initiative, we are already sure that these things create value to our users. So that's one of the recipe since the day one. We are not only contribution margin positive, but also cash cycle neutral to positive. So it's just a matter of time for us to be a bit positive and in our business. The other part of the way how we approach this is that we are being frugal to the cost. One aspect of the cost that we usually forget is about the salary. We invest a lot in technology, in developing the platform to automate things, but then we sometimes forget to look at the workload analysis of our team. At FMOS, we do that regularly. We do analyze the workload of every individual by name, by person, to understand whether this role is relevant anymore or not. That keeps us to have optimum number of people in our team, and at the same time saving the cost. The combination of those two things, number one, an understanding about the value creation concept, not only on the founder's level, but other leadership level, as well as being frugal in terms of managing costs, especially the salary. I think one of the key for a startup to be financially sustainable.
Yeah, I totally agree with what the gentlemen here are saying. Can totally resonate with what Gibran was saying. Pinhome is a business that was incepted at the gate of pandemic and has been growing, scaling exclusively in economic challenging economic times, economic downturns. I think seed stage we were at alpha, and then beta, and then Series A we were at delta, and then omicron, and then inflationary environment, and now what, like recession maybe. So we had that mentality. We've been having that mentality since day one that it's not only about top line, not enough about midline. It has to be about bottom line, and then ultimately it's about cash flow line, right? That balanced growth is what we're after. Top line, yes, it has to grow, but it's not just about volume GMV. We need to look at revenue and what is the contribution margin of the revenue that comes in, and look at the product mix and make sure that we're pushing the product that has, of course, the best or the better margin. There are products with less margins, but is there any other value that this product brings? Maybe it's a traffic puller, so just be very conscious where margins are thin, why are we pushing for that product? And then in the midline, as we see that unit economic positive product is growing, then we grow our gross profit. Then being cognizant about costs, definitely what Gufran was saying is really true. Like, I am approving every single dollar that goes out. My co-founder is basically releasing every dollar that's being spent, and we are really frugal and cognizant, and that really hasn't stopped up until today. We're not yet EBITDA positive, but that's what we are after. So within 2022, we cut our burn by 50%, and now the goal is towards profitability. But at the same time, also looking at the cash flow line, right? And I think what Gibran really true, that it's not enough to be EBITDA positive, but let's say your revenues are in account receivables, and let's say collection is lousy, and that might not translate into actual money in the bank. So account receivables, so just making sure that cash outflow is extremely optimal, efficient, so everything that's spent really translates to good IRR or ROI, and that every inflow of money, right, that account receivables are being collected. If you sit on piles of cash, make sure you at least have a treasury unit, right, to maintain your cash, so it's not getting eaten by inflation, for example. So all those things.
Got it. Thank you, Dara. So I want to touch on the topic of regional presence quickly, and this question is directed specifically for Chris and Harshet. So all of you have regional presence. So all of you here, all of your companies here have presence in Indonesia, but specifically for both your companies, you guys have expanded out of Indonesia. So I think for you, Harshet, you've started Koala from the get-go as a regional play, and for you, Chris, you've expanded to Vietnam after having a very successful run here. So do you mind just explaining to the audience why you believe it's important to expand regionally when Indonesia is already such a big market, and how difficult has that journey been for you? Maybe Chris, you want to start?
Thank you. So I think for us, the difference is that because as an ecosystem, we have the luxury when we decided to expand to another industry or when we want to expand to another territory, we don't need to burn all the way just to get the market shares. We have the benefit from the ecosystem as a flywheel. So what it does is, like, when we come to Vietnam, actually, we are not coming as a zero, right? We don't need to rebuild the whole technology that we already have in here. We have the know-how, and at the same time, we have the leverage of knowing and then have the scale in Indonesia as one of the biggest market, as a negotiation power to all the brands to become our partners, right? So when we first start in Vietnam, we easily start with more than 200 brands from day one, and at the same time, it's quite easy for us to scale the number of stores, the number of e-commerce over there, because we already have the know-how. We have all the templates that we have from Indonesia, right? And as a flywheel, the concept is that anything that we did into one of the pillars of the business is supposed to give positive impacts to another pillar of the existing business as well. So in our case, when we expand to Vietnam, it's quite interesting because it all happens during the pandemic, right? Definitely when we plan this, the pandemic has not happened yet, and no one knows. And when it happens, the expansion is really happening 100% remotely. Like, everyone is, I didn't meet any single of my team in Vietnam during the setup period. But the benefit is really true, because then when we have that operation in Vietnam running and we have a bigger scale, And we have a lot of knowledge that we can transfer from Vietnam to Indonesia as well as Indonesia to Vietnam, including the understanding and the insights from the customers' behavior as well. And at the same time, because of the scale that we have in the two countries, then we also have much more benefit when we talk to the brand around the world, right? When it comes to and it's also helping the local brands in Indonesia. Last year, we managed to bring 3 of the local champion brands to Vietnam. And because of the scale that we have in Vietnam, it's quite easy for us to introduce the brands, even though we don't need to invest a lot in marketing. So all in all, I think this is a concept of the ecosystem that runs as a flywheel. It's going to help us, and when we do the expansions to another territory as well.
Yeah, I think for us, the thought about being regional came quite naturally because I think I'll try to break it down. I think first things, fundamentals of the industry, right? For most industries, Indonesia will be the largest in the region. Like, let's say you want to drink water. Probably by the law of large numbers, number of people here, most water is drunk in Indonesia compared to other countries, right? But in insurance, Thailand is 3 times larger than Indonesia. So the market size is simply much bigger, for example, right? Malaysia is much bigger as well. Singapore is much bigger as well. So Indonesia is growing faster, but has a long way to catch up, right? So for us, actually, by expanding, we were able to get into markets which were already much deeper into insurance. Insurance was better understood. Secondly, Indonesia is obviously loved by VCs and private equity companies, right? I think it's fair to say that much love is not shown to some of these other markets. And that means that the competition that we face there is more traditional, and they tend to behave themselves a lot more. They're trying to be profitable companies, which in turn allows us to behave better as well, right, to some extent. And it means that we have that lever of saying, even if in Indonesia we have to be very aggressive, we can have a different kind of lever by going into those other markets, and that balances the company, right? And then third, I think when we start building the tech behind it, and I said earlier, insurance is intangible, right? Which means that, when we were building the tech, we began to specialize a little bit in how to build the stack out, how to build the services around it. And most of these services are digital services, not like logistics, right? Which you need physical infrastructure. All of it is cloud infrastructure, right? And so for us, it's not difficult to deploy in almost any country in the world. And hence, and since there were a lot of our partners who were regional, we were able to follow them, right? And lastly, I know we just talked about sustainability, but I also believe that it's not, while we're all chasing better profitability and so on, I don't think turning a profit in the short term is right strategy for all businesses. For some businesses, it might still be the wrong strategy. And I think even for us, given we're in a slightly more nascent industry, we actually feel it's an opportune time that as long as we have good economics, there will be an artificial ceiling of how much we can grow in a non-demand-based product like insurance. People don't wake up and dream of wanting insurance, right? So there will be some artificial ceiling of maybe you cannot grow at 20 times a year, maybe 5 times or 3 times is probably the limit. So by entering more markets, we could continue that growth for a longer period of time. And that might be true for some of the other industries that you're in as well. Yeah.
Got it, thanks. Next, I have a question for Gibran and Dara specifically, and it's talking about financial services. So I know both your companies are not in a pure financial services company, but I believe both of your companies have done something quite interesting with financial services and adopting that within your ecosystem. So do you mind explaining to the audience what exactly that you're doing with financial services and why you believe it's important to be embedding financial services within your ecosystems itself? Dara, you want to start?
Absolutely. It's a great question, Petra. Thank you so much. We are half PropTech, half FinTech as a business. Since day one, we built and try to equal balance between the two, and that's basically for 3 reasons. One is that FinTech or financial services are inseparable part of real estate or property, right? As an asset class, all stakeholders in real estate really rely on financing to operate. Developers are basically reliant on project financing to build homes. Home seekers or property buyers are reliant on mortgage basically to do home transactions to buy homes. And every single stakeholder, like if you just look at how reliant are they on financial services? All of them are very reliant. It's a massive opportunity, right? If you think of financial service as a function of asset, the size of assets, right? Real estate in Indonesia is a $5 trillion worth of asset class, probably the largest, if not one of the largest asset class in the country. If you think about financial service size as, you know, in a concept of LTV, right? On average, 80% LTV for real estate assets is $4 trillion opportunity for the financing. So that's the first reason. Second reason, that it is extremely underpenetrated. This is a country, you know, $1 trillion economy, but mortgage origination capacity is just 3% of the GDP, right? Compared to in China, that's at least 55%. In the States, 80-90% mortgage origination capacity of total GDP. Even in India, $2.7 trillion economy, mortgage is 12%. It's a double-digit percentage origination capacity of GDP. Indonesia is very small, $30 billion mortgage origination capacity. That's it. And if you look at other type of kind of financing products, right, within real estate, it's even more underpenetrated. So it is ripe for disruption because it's just you know, it's barely there. And so we want to be there and help financing more accessible. I think the last but not the least is that it's one important way for us to hook stakeholders to transact on platform. There are different ways for real estate players basically to lock transactions. Asset is one way, iBuying. Another way would be locking agents and agencies, employing them, Peike, you know, Lianjia in China, that's what they're doing. Financing is a very important way, and we see a lot of real estate proptech players are successful because they have very compelling financing product. Other than that, you know, locking the demand side, like the Zillow model, how they just become kind of the single source of truth for any real estate information, that's another way, right? We're tackling every single pillars of kind of locking transaction within the ecosystem, and financing is a very important piece of it.
Thank you.
Yeah, for us, we're not a fintech company, right? We're a fish tech company, but since most fish has fins, so it's an integral part of the, no, kidding. But when, as I mentioned earlier, we focus on solving farmers' problems. When we started solving farmers' problems on the feeding side, we start selling feed to the farmers. And a lot of farmers, when they buy the feed from us, they ask whether they can buy the feed on credit, because that's the way that they're usually done. They receive the cash when they harvest. They want to buy the feed first and then pay it after harvest. But we couldn't do it. And then we tried to figure out when they're getting their loans right now. And mostly they're getting the loans from middlemen and loan sharks. And then when we check with what type of loans that they're getting, it's in a quite unique structure when there's a markup on the fee around 10 to 20%. But the middlemen, they're locked on the middleman, and then the middlemen cut the harvest. As a harvest fee, which is 7 to 10%. And harvest value is much higher. So in the context of cost of financing, it could be like 40 to 70% per annum that they're getting, which is massive. And that's why like farmers in the bottom of the pyramid, they can't really foster because their livelihood is really pressured by this financing component that strangled their neck. So trying to solve that, we tried to figure out, why aren't you getting any form of financing from the banks and other financial institutions? When we talk to banks and financial institutions, in one particular cases, the farmers have like $100,000 asset, which is in the form of pond land, and they would like to get like $50,000 loan from a bank, which is only 50%, which I think for the banks it would be no-brainer for them to give it. But the bank said no. And when I asked, why do you say no? Is it because of high risk? No. If it's high risk, it's easy. We can just take a high price. But the risk is uncertain. So that's why with the uncertainty, we can't really give it, because the fish inside of the pond is brown. So you don't really know whether there's actually a fish there, whether if they put the feed, whether the fish will eat the fish, which is, when that's, I got the epiphany on doing that. Well, thank God I can do that actually, because I have the data to figure out whether there's actually a fish there. So I can put a certainty on building that. And on that sense, then we try to build the credit scoring by translating the harvest, translating the feed data which we can capture to then some sort of like financial report. Then we can work with the financial institutions. And then for them to then provide financing solution to the farmers, we work with the fintech, peer-to-peer lendings, and the banks to provide financing limit in a form of BNPL model. So like credit card limit that the farmers can only buy and can only utilize it to use to buy the feed on credit. And we have the whole ecosystem, right? If they buy the feed on credit, they don't receive the cash, they receive the feed. If they want to disburse the feed, it's assured that it won't be resell and they receive the cash and side streaming. It will be assured to provide it and disburse through the pond that will create the cash. And then we can do the offtake, so we use the fish as a collateral. So we're like an ideal partner for the banks because we're probably one of the very few company that can use the fish as collateral. So that's how we launch the units right now. Then right now with the scale of disbursement of 100 million per year.
Got it. Thank you so much, Gibran. So I know we're running a little bit short on time, so I have one quick question for Gufron, and then just one quick question from the audience as well. So Gufron, I want to ask a question about social commerce in the context of e-commerce. Do you think, what role does social commerce play in the context of e-commerce? And do you think that social commerce is the right substitute for general e-commerce in rural areas and tier 2 and tier 3 cities where shipping costs are higher and internet penetration is also lower?
Yeah. So I'm practicing the first thinking principle in this questions. So to answer that questions, if we are if we are looking at from the user's perspective, which is the brand owners, they don't care whether they sell it through e-commerce, social commerce, or offline commerce. What matters to them are two. What channel that can help them expand their business, and then number two, that channel, the all-in cost making sense. So due to that fact, Aframos, we don't want to be categorized simply with a simplified label such as social commerce or traditional e-commerce, but we are trying to think bigger than that. What we want to do is to enable retail for the local brands. So the local brands can leverage Aframos to be able to expand and widen their market presence. And yes, we are starting with building a reseller network across Indonesia as the means, as a shared asset that the brands can use. But the idea of Aframos itself doesn't stop at that. We are always trying to figure out the ways on how we can innovate in serving better, delivering value better to our brands in terms of making them bigger in their market presence.
Got it. Thanks so much, Gufron. So it doesn't look like we have time for questions from the audience. That concludes our discussion for today. So I'd like to thank the audience for listening so intently. And most importantly, I'd like to thank the panelists who have spared some of their very valuable time to be sharing their insights with all of you. So let's give them a big round of applause.
Thank you.
Thanks.